Hi, everybody. Thank you for joining this session, session 3 of the day, Climate Change and Fiscal Monetary Policy, Fiscal and Monetary Policy. And we have 3 wonderful analysts. Yannis Dafermos, Senior Lecturer in Economics at SOAS University of London. He's also the Research and Knowledge Exchange Convener of the SOAS Department of Economics, a Senior Fellow with the SOAS Center for Sustainable Finance, and a Fellow at the Forum for Macroeconomics and Macroeconomic Policies. Research interests include financial macroeconomics, climate finance, ecological macroeconomics, climate-aligned development, and inequality. His work has been published in several peer-reviewed journals, such as the Cambridge Journal of Economics, Ecological Economics, Environment and Planning A, the Journal of Financial Stability, Nature, Climate Change, and New Political Economy. He's a committee member of the Post-Keynesian Economic Society and a council member of the European Association for Evolutionary Political Economy. Yannis, thanks for joining us. Dr. Maria Nikolaidi, Associate Professor in Economics at the University of Greenwich, also a Fellow at the Forum for Macroeconomics and Macroeconomic Policies. Her research areas include macro-financial policies, ecological macroeconomics, and financial fragility. Her work has been published in peer-reviewed journals, including the Cambridge Journal of Economics, Ecological Economics, the Journal of Financial Stability, the Journal of Economic Surveys, and Structural Change in Economic Dynamics. She's worked on research projects on ecological macroeconomic modeling, the greening of monetary policy, and the links between income distribution and growth. She is also a member of the committee of the Post-Keynesian Economics Society, as well as a trustee of the Foundation for European Economic Development. And finally, William Oman, economist at the International Monetary Fund, work in the Monetary and Capital Markets Department, focuses on climate and nature-related risks, monetary and financial policies, and the macro-financial implications of the ecological transition. Previously, he worked in the IMF's European Department in the IMF Europe office and at Rubini Global Economics, where he covered the euro area. And I'll be the moderator. My name again is Peter Coy. I am an opinion writer for the New York Times, writing about economics and related topics. And please subscribe to my newsletter. It comes out 3 days a week. So the plan is to have each of the 3 speakers speak for 20 minutes, after which we will have half an hour of Q&A. That'll be a couple questions from me. I hope we'll get a lot of questions from the audience. Please use the Q&A function. And I also hope there'll be a little bit of interchange between the presenters. So with that, we will begin. And Emily, can you remind me who we have going first?
Yannis is going first.
Yannis. Okay, Yannis, take it away.
Thank you so much, Peter, for the introduction. And first, thank Dimitri and the Levy Economics Institute for the invitation. It's a great pleasure to be presenting at this conference. And what I'm going to do in my presentation is basically to explain why, in my view, we need to completely rethink fiscal and monetary policy because of the climate crisis. And the first thing that I would like to highlight is that there is now a broad consensus that climate change is transforming completely the global economy. Of course, there is a consensus that comes from climate scientists that the global ecosystems are being transformed because of climate change. But despite the fact that we have this consensus, if we look at the developments that we have seen recently in fiscal policy and monetary policy, we can very easily realize that we are not doing enough. I mean, we have a climate emergency, and there are no governments around the world that have introduced very ambitious green fiscal policy packages, as someone would expect based on the climate crisis that we are dealing with. We have some recent interesting developments. For instance, we have the Inflation Reduction Act in the US. I'm going to talk about it in a bit, but we haven't seen any comprehensive fiscal policy packages so far that refer to climate change. And when we turn to central banks and financial supervisors, we have some interesting developments there. Some of you might know that a few years ago, we had the launch of the Network for Greening the Financial System, the NGFS. And based on that, many central banks and financial supervisors have engaged with climate-related issues. They have tried to analyze climate risks, but we haven't seen very active responses from central banks and financial supervisors as well. And I think that broadly speaking, despite the fact that governments, of course, have the key role to play in addressing the climate crisis. It would be great if we had a more active role from central banks and financial supervisors as well. So what I'm going to do in the next minutes is basically to explain which are the main implications of the climate crisis for fiscal and monetary policy from my perspective. And I will also try to explain why, in my view, these implications are very fundamental and how we can transform fiscal and monetary policy due to the climate emergency. So let me start with fiscal policy. And the first implication that I would like to highlight is that the less governments are willing to spend right now on climate, the more they might need to spend later. And let me explain what I mean by that. When we are looking at climate spending, we can make a distinction between three different types of spending. We have, first of all, the so-called climate mitigation spending. This is spending that needs to be done in order to reduce carbon dioxide emissions primarily. So whenever we have the governments invest in public transport, when they provide green subsidies, when we have a regulation that tries to improve the energy efficiency of public buildings and so on, these are types of spending that try to reduce greenhouse gas emissions, and they contribute to climate mitigation. Now, this is a type of spending that we need to do right now in order to avoid further increases in global warming. If we don't have enough climate mitigation spending, then it will be necessary in the coming years to spend more in what is called climate adaptation. And climate adaptation has to do, for instance, with the spending that is necessary in order to build flood defenses, in order to develop systems that protect us from storms, any spending that has to do with the so-called climate smart agriculture, which tries to improve how we basically use crops, how we protect the animals from the fact that we have less water. So this type of spending will be done much more in the coming years if we don't deal with the climate change problem right now. And on top of it, we have the loss and damage spending, which is spending that has to do, for instance, with dealing with financial losses once we have a climate-related event. In many cases, there is a lot of reconstruction that has to take place after a hurricane, after a typhoon, and governments will need to step in and support people who have suffered from climate change in order to be able to avoid further negative effects of climate change. So even if governments don't want to deal with the climate problem, they will need to deal with the fact that they will have to spend more in the coming years for climate adaptation and losses and damages. And of course, this will in any case have significant implications for public debt. Now, the other thing that I would like to highlight, and in my view, this is a very significant implication of the problem that we have to deal with, is that we cannot rely on a specific single fiscal policy tool in order to decarbonize our economies. And let me explain why this is the case. Here I have a graph from the recent IPCC report, which shows the evolution of greenhouse gas emissions over the last 20 years. And you can see that there's a very clear trend here. We have seen an almost continuous increase in greenhouse gas emissions over the last 20 years. And here IPCC has specified what we need to do in order to be close to the targets of the Paris Agreement, according to which we need to reduce global warming to close to 1.5 or 2 degrees. If we're going to do that, it will be necessary to reduce carbon dioxide emissions extremely quickly and to have a pathway that is very much inconsistent with what we have seen so far. So we are talking about a very significant transformation of our economies. We are talking about a decarbonization process that is not easy to happen. If we don't do that, we will have that greenhouse gas emissions will probably stabilize. I mean, this is one of the business as usual scenarios in IPCC. And it means that we are going to have at the end of the century about 3 degrees, which of course is an extremely bad scenario. We really need to avoid something like that, because in that case, governments in any case will need to spend a lot on climate adaptation and losses and damages, as I explained before. Now, can we achieve this deep decarbonization of our economies by relying only on one single fiscal policy tool? And my answer is no. However, for many years, economists, and in particular those who have worked primarily with mainstream economic models, have argued that there is one single way to address the climate crisis, and this is to put a price on carbon. And within the mainstream framework, the idea is that by putting a price on carbon, we internalize an externality, and the externality is climate change. Now, we have seen some recent attempts to increase carbon prices around the world. There have been some countries that have recently introduced some carbon pricing schemes. I have here a map which illustrates some recent developments. When we are talking about the carbon price, we make a distinction between the carbon tax and an emissions trading scheme. When we have a carbon tax, the government decides about the price of carbon. When we have a trading scheme, it's basically the price of carbon is basically the result of demand and supply. So in Europe, there are many countries that have both a carbon tax, and we also have the emissions trading scheme that refers to many European countries. Recently, South Africa, Argentina introduced some carbon tax schemes. So we have seen some interesting developments there, but broadly speaking, the price of carbon is still very low. Now, someone could argue that what we need to do is basically to start increasing the carbon price and introduce more carbon pricing schemes around the world. And the problem with that is that, of course, this is useful and it can have some positive environmental effects. But we know that carbon pricing by itself can lead to significant economic and financial problems, because increasing the price of carbon can create some recession in the economy. And on top of it, we know that carbon pricing has a lot of inequality effects. At the same time, we know that if we just increase carbon prices, we are not going to see a significant reduction of emissions. So it might be a useful policy, but we cannot use it by itself. How about green subsidies? There has been a lot of discussion about the green subsidies in the context of the Inflation Reduction Act. I have here a graph which shows the green tax credits that have been provided by that will be provided by the US government in the context of the Inflation Reduction Act. And we're talking about a quite ambitious program, in the sense that we have a lot of spending related not only to the energy sector of the economy, but we have spending that has to do with buildings, we have spending that has to do with the use of electric cars. So this is of course a good development. However, green subsidies have a specific problem, and the problem is that whenever we have the green subsidies increase, we have an expansion of the economy. Now, having an expansion of the economy is good because, of course, we have more economic growth, more jobs, and so on. However, from an ecological economics perspective, if we rely on green subsidies, we have higher economic activity, we have what is called macroeconomic rebound effects. Now, macroeconomic rebound effects refer to the fact that until we decarbonize completely our economies, whenever income increases, people spend money that leads to additional carbon dioxide emissions. And this means that if we just rely on green subsidies, we might not achieve a reduction in emissions that is in line with what we would like to achieve if we didn't have the macroeconomic rebound effects. We have to take this into account because it implies that green subsidies by themselves might not be sufficient. And another issue that I would like to highlight, and this is important for green subsidies, but also for other similar green fiscal policy tools, is that the green transition requires a significant amount of specific materials. This can be, for instance, lithium, copper, materials that are necessary for batteries, for solar panels, and so on. And the challenge that we have right now is that because of the fact that we have delayed the green transition, we now need to invest quite quickly in green technologies, but we need a significant amount of these materials. And many of these materials come from countries in the global south. And the challenge is that since the demand will be very high, we know that in many cases, communities in the global south are exploited because we have this high demand for these green materials. And there is a risk that we might see something like that as a result of the green transition. So we need to be very careful and find ways to deal with that. Now, if we talk about green fiscal policy in general, what I've just said implies that we need to have a combination of tools that are used at the same time. For instance, we need to have some tools like carbon taxing that is a kind of a stick, and at the same time to have green subsidies that can be considered as carrots. And when we combine them, we have two advantages. One advantage is that we can maximize the environmental effects, because when companies pay a price on carbon and at the same time some SMEs that might not have financial capacity get subsidies from the government, both of them are incentivized to invest more in the green economy. And this is good in order to reduce emissions as much as possible. At the same time, when we have both sticks and carrots, we can avoid some side effects of having only carrots or having only sticks. It's also very important to focus much more on the role of green public investment. I mean, in many countries around the world, the energy sector is owned by the government. In that case, the governments have a very clear role to play in decarbonizing the economy. This is not the case. The governments can decarbonize the public transportation, for instance. And this is very important because when we have that, for instance, in cities, we have that governments invest sufficiently in public transport. This means that we can also deal with the fact that people might not use their cars so much, and this can have some spillover effects that are positive from the environmental perspective. And just to say that at the same time, of course, we need to combine fiscal policy tools with environmental regulation, because environmental regulation can provide a very clear pathway about what the private sector needs to do. And if this is combined with some support from the government, this is the best way to achieve a smooth transition to a low carbon economy. So there is no single fiscal policy tool that is enough. We need a combination of policies. Now, the last implication of the climate crisis for fiscal policy is related with what is happening in the global south. So there has been a lot of discussion about the fact that those countries that are more vulnerable to climate change are the countries that also have the lowest responsibility for the climate crisis. So if we think, for instance, about Bangladesh, Philippines, Malaysia, I mean, countries that haven't contributed so much to carbon emissions, these are countries that also are facing right now very significant negative effects because of climate change. And the problem that we have is the following, and this is what I have on the slide. The problem is that when we are talking about these countries, they need to invest quite a lot in climate adaptation. But because of the fact that they suffer from climate change, they need to spend a lot of money also on losses and damages. This increases public debt. And there are studies that show that there's also a negative effect on the cost of borrowing. And as the cost of borrowing goes up, there is less capacity for these countries to invest in adaptation. And the less they invest in climate adaptation, the more climate vulnerable they become. And this intensifies even more the problem with the cost of borrowing. So we have this vicious cycle, which is quite important for these countries. And this vicious cycle is going perhaps to become worse. Why? Because the credit rating agencies are already trying to analyze how their ratings are going to be affected by the climate crisis. And here I have an example from Moody's, which illustrates which are the countries that might see a reduction in their ratings as a result of climate change. And you can see with the red color that these are countries like Bangladesh, India, many countries in Africa, which are going to see perhaps an increase in their cost of borrowing, not because of the fact that they have a significant responsibility for the climate crisis, but simply because of the fact that they are very climate vulnerable. We have to take this into account because if these countries want to implement green fiscal policy packages, they don't have the same capacity as, for instance, the US or countries in Europe. And of course, this has been considered quite a lot in the negotiations about climate change. And there has been some finance that has been provided from countries in the global north to countries in the global south in the context of the United Nations Framework Convention on Climate Change. The problem, however, is that this amount of finance is very small compared to what is required. So we still haven't achieved the target of $100 billion US. And I have here two graphs that illustrate that another problem is that most of this finance refers to climate mitigation, not to climate adaptation, which is a key priority for these countries. Second, we have that most of this finance has been provided in the form of loans, not in the form of grants. And this means that this can increase even more the debt of these countries. So we need ambitious policy packages in high-income countries, but we also need to deal with the fact that the global financial architecture doesn't help countries in the global south to implement ambitious fiscal policy packages as well. And let me now turn to monetary policy. And the first implication of climate change for monetary policy is that climate change is completely changed the way that inflation is determined. There was a very well-known speech by Schnabel last year where she highlighted that there's three new sources of inflation because of climate change. We have the so-called climateflation, that is related with the fact that the climate change increases the severity and frequency of climate-related events. This can lead to supply-side shocks, and central banks have a very little control over these types of shocks. We have the so-called fossil inflation. This is inflation that is related with the increase in the price of carbon, for instance, because of carbon pricing that I mentioned before. And if we have that this happens, then energy prices can go up, and this can be passed on the general level of prices. Finally, we have the so-called greenflation. This is linked with what I said before about the materials that are necessary for the green transition. So if we have that there's a very high demand for specific types of green materials, there might be an increase in the price of these materials. And as these materials become more important for the green economy, this can also have an impact on inflation. So this is a kind of a new reality. Central banks don't have tools to deal with these types of inflation. And on top of it, there has been a lot of discussion about the fact that climate change also affects the so-called transmission channels of monetary policy. I have here a graph from the Network for Greening the Financial System, who have published a report where they have highlighted that many of the channels that central banks in theory use in order to determine interest rates will be impaired as a result of climate change. Just to mention one of them, the credit process is being affected by climate change, because when we have climate-related events, banks become less willing to provide credit to the economy. So even if central banks reduce interest rates, this is not going to affect perhaps their willingness to provide credit. And this means that any change in the interest rate, a reduction in the interest rate in that case, will not translate into changes in inflation. What does it mean? It means that central banks will gradually need to accept that they cannot easily control inflation. I mean, there's a big debate about how much they can control inflation right now, but things might become even worse from their perspective because of the climate crisis. Second implication is that central banks, of course, cannot save the planet, but they cannot undermine the climate transition. And I have here a very precise example about that. And the example is the key program of the ECB. We have done some analysis with Maria and other colleagues where we have illustrated that there is a carbon bias in the key program of the ECB. And in practice, this means that the ECB has supported carbon-intensive sectors much more compared to the rest of the sectors. And despite the fact that these sectors do not have the same contribution to the economy. So for instance, we can see that they have bought proportionally much more fossil fuel bonds compared to the contribution of fossil fuel sectors to the gross value added of the economy. This carbon bias has been recognized by the ECB, and are now trying to deal with that. But in general, we have similar carbon biases in many financial and monetary policy programs, and we need to get to the stage whereby we don't rely on market neutrality, but we have the central banks also focus on climate neutrality. And let me finish with a last implication, which refers to the fact that climate change is creating some new source of financial instability. And we know that many households, many firms, many governments are going to suffer quite a lot from climate-related events. And then central banks need to find ways to address this type of financial instability. And they cannot just try to reduce their exposure to governments or firms that suffer from climate change. We will need to have new approaches whereby central banks trying to intervene in a way that stabilizes the financial system in the context of climate change. And I'm happy to explain more how they can do that in the Q&A session. I have run out of time. Thank you very much, and I very much look forward to your questions and comments. Thanks a lot.
Yannis, thank you very much. And yes, if there's anything you failed to cover now, you probably will get a chance to get it across in the Q&A. But for now, we're going to move on to Maria. Maria, it's all yours.
Thank you so much. Thank you so much, Peter. In my presentation, I would like to focus on fiscal and monetary policy tools that could be used in order to support the decarbonization process. I will follow up on some of the issues that Yannis mentioned in his talk, and I will give some more details about the design of macroeconomic policy tools and some of the effects of these tools on the economy and the environment. Let me start with an overview of the most important, let's say, macroeconomic policy tools that could be used to support the transition to a low carbon economy. I think that fiscal policy tools should be at the center of macroeconomic policy mixes. We could use carbon taxes, green subsidies, and green public investment in order to support the transition. Monetary and financial policies could have a complementary role. For example, central banks could decarbonize their asset purchases. Central banks could tilt their bonds toward companies that are good climate performers. Another example is that we can rely more on green public banking instead of relying only on private commercial banks and shadow banks. And another example that we could use in order to support the transition to a low carbon economy is to adjust financial regulation, and in particular adjust the capital that banks hold in order to promote green lending and reduce lending that is provided to the dirty companies. Let me start with green fiscal policies and show you some of the effects of some of these green fiscal policies. In order to do that, I'm going to use an ecological stock flow system model that we have co-developed with Yannis and Yorgos Galanis. We call the model DEFINE. DEFINE stands for Dynamic Ecosystem Finance Economy, and it is a model for the global economy, and we have used it in order to analyze various hypothetical scenarios. I want to show you the effects of three different policy tools that are introduced in 2024. In the first case, I want to show you what could happen if we increase the carbon tax in line with one of the IPCC scenarios. The first one, the second policy that I would like to show you is what will happen if we combine carbon taxes with green subsidies. So what will happen if the government collects revenues from carbon taxes and then redistribute these taxes to companies that increase their green investment in the form of subsidies. And the third policy that I would like to focus on is on a green public investment, and I would like to show you what could happen if we increase green investment as a proportion to GDP from 0.2% to 0.8%. So in order to show you the effects of these three different policies that I mentioned before, I have two figures on the slides that shows what is happening with the growth rate of output and the rate of default on loans. All of the policies are compared with a so-called baseline scenario, in which case we do not incorporate any new policy. When we introduce only carbon taxes, we see that firms have less profits because they have to pay for these taxes, and as a result, they reduce their investment, and gradually we have a decline in economic activity. At some point, firms are able to reduce their emissions, so they are able to increase their profitability, and this is the turning point in which the growth rate of output increases. What about the ability of the firms to pay the loans? When we introduce only carbon taxes, we can see that firms are not so able to repay their loans, basically because they have less profits in order to do so. So this is in line a bit with the so-called climate misting moment. When we introduce both carbon taxes and green subsidies, we avoid this decline in the growth rate of output and this increase in the rate of default of loans, basically because at the aggregate within the firm sector, at the aggregate level within the firms, they do not experience a decline in their profitability. So this is why the growth rate of output is pretty much the same as in the baseline scenario, and firms do not experience an inability to repay the loans. When we introduce only green public investment, there is an increase in economic activity, and because of the multiplier effects, we have this increase in economic activity. Firms are able to make more sales, households have a higher income in order to buy goods and services. So overall, this supports the profitability of the firm sector, and this is why we have that the rate of default of loans is lower compared to the baseline scenario, which shows actually that they are more able to repay the loans. We are also interested in what's happening on the public debt to GDP ratio, not because we think that this is an important indicator, but especially this is the case. So high-income countries do not have a problem in having a relatively high public to GDP ratio, but we want to understand what is happening when we introduce various green fiscal policies. In principle, we expect that an increase in green public investment should increase the public debt to GDP ratio. However, in the simulations, this is not the case. Indeed, we have that the green public investment increases public debt, but economic activity increases even more. And as a result of this, the public debt to GDP ratio becomes lower compared to the baseline scenario. When we introduce only carbon taxes, we see that the public debt to GDP ratio becomes higher compared to the baseline scenario, basically because of this decline in economic activity that I mentioned before. Overall, the public debt to GDP ratio at the end of the century is lower compared to what we get in our baseline case, basically because we have less emissions and less climate damages. In all cases, when we introduce these fiscal policies, we achieve a lower atmospheric temperature, but as you can see from the figure, this is not enough in order to achieve the 1.5 or 2 degrees Celsius, which is in line with the Paris Agreement. In order to evaluate the effects of these fiscal policy tools, we have identified a set of indicators. A set of indicators is linked with the macroeconomy. We have chosen the unemployment rate, the wage share, which can capture some aspects of income inequality. We have another set of indicators that focus on the financial aspect of the economy. It's not only the rate of default and the public debt to GDP ratio that I mentioned earlier. We have also included the leverage ratio of banks that can capture the financial fragility of the banking sector. And we have another set of indicators that is linked with the environment, not only atmospheric temperature linked with climate change, but also the waste per capita that can capture non-climate change effects. So we investigate the effects of the fiscal policies that I mentioned before, both in the short and in the long run. And if we have a color that it is red or light red, this means that the indicator becomes worse compared to the baseline scenario. If the color is green or light green, it means that the indicator has improved compared to the baseline scenario. So when we introduce only carbon carbon taxes, we can see that unemployment rate becomes worse at the end of our simulations, and at the same time we have a worsening of income inequality. We don't only have this increase in the rate of default, increase in public debt to GDP ratio that I mentioned before, also the banks become more fragile. This is because of this inability of the companies to repay the loans, so their capital is negatively affected. When we combine carbon taxes with green subsidies, we avoid all these negative effects. Similarly, we don't have negative effects when we introduce only green public investment. The only issue that we have is that at the end of our simulations, there is an increase in the waste per capita compared to the baseline scenario, which shows a non-climate change environmental negative effect that we cannot rely continuously on an increasing growth. Now I would like to focus a bit on policies that could be used in order to decarbonize the financial system. And I would say that we need to decarbonize our financial system. If you have a look at the figure that I have on the slide, it shows the amount of funding that is provided to fossil fuel companies between 2016 and 2022. As you can see, most of the banks are banks in developed countries like the UK, US and Canada. JP Morgan Chase on its own has provided close to $550 billion to fossil fuel companies between 2060 and 2022. It's also interesting that at the same time, some of these banks have announced that they have provided a lot of funding to support green companies. However, when we compare this amount of funding to the funding that they provide to fossil fuel companies, obviously it's very, very small. So obviously there are issues of greenwashing. So I would say that there is a need to decarbonize the financial system, and we can use various policies. So we can have more green public banks. In the US, there are not so many public banks. In Europe, there are some. For example, the UK had a public bank, but it sold it in 2017. They created a new one in 2021. They call it the UK Infrastructure Bank, and it has a financial capacity equal to £20 billion in order to provide loans to the economy. However, they do not specify, they do not have a specific target for the amount of lending that they're going to give in order to support the green economy. Other European banks, like the well-known European Investment Bank, has identified specific targets for the lending that they have to support the green economy. They have also announced that they have stopped providing funding for specific fossil fuel projects. However, there is a lot of discussion whether the European Investment Bank keeps providing funding to fossil fuel companies. And obviously this is linked with the way that we define the green sectors and the dirty companies. Of course, the capital of the European Investment Bank is much larger than the capital of the UK Infrastructure Bank, but in any case is not large enough in order to support the transition to a low carbon economy. So we need to increase even more the capital of the European Investment Bank in order to achieve the decarbonization of the financial system. Central banks could also support the transition to a low carbon economy. As I said at the beginning, central banks could tilt their purchases toward bonds that have a better climate performance and reduce the holdings for issuers that do not have a good climate performance. In 2021, the Bank of England decided decided to green their corporate QE program. They call it a CBPS. We have done some work on this with Yannis, Daniela Gabor, and Frank van Leven. And actually, we have shown that despite the fact that is in the right direction, is not ambitious enough. We actually argue that this is because the bank has kept the so-called market neutrality principle. So if 6% of the bonds that are issued by the gas companies in the financial markets, then the central bank needs to buy 6% of the holdings of bonds that are issued by gas companies. So in this way, the Bank of England will not distort the market, but obviously this has limitations for how quickly we can decarbonize the asset purchases of the bank. So if you have a look at the figure that I have on the slide, indeed the bank can tilt their purchases towards very strong or stronger climate performance. However, this tilting takes place within the sector in order to avoid distorting the market, and obviously the decarbonization could not be sufficient enough. So we argue that the bank should be more in favor of the so-called climate neutrality, and it should actually abandon the so-called market neutrality. We also argue that the Bank of England has a lot of support for companies to improve their climate performance, but they do not have a lot of penalties early on to companies that do not perform very well with respect to climate. So the ECB is more ambitious compared to the Bank of England. In particular, in October 2022, the ECB started decarbonizing its corporate QE program, and they have the metrics that they have used in order to tilt their purchases. They rely on backward-looking information, which includes different types of emissions like Scope 1, Scope 2, and the sectoral average Scope 3 emissions. They also rely on forward-looking information. So the bank considers the plans that some companies have in order to reduce their emissions within the next years. So based on that, they capture what we call the climate footprint, and they tilt the purchases towards companies that have good climate performance. However, this tilting refers only to reinvestments, which obviously is problematic. So if there is a bond issued by a carbon-intensive company, a fossil fuel company, for example, and it matures in 2025, the ECB will not do anything about this bond. So we argue that it makes sense that this tilting not to take place only within reinvestments, but also it should refer to the whole stock of the holdings of the ECB. Central banks could also decarbonize the collateral framework. We know that eligible banks can get access to liquidity from central banks. In order to do that, they use a collateral. The difference between the value of the collateral and the amount of liquidity that they get from the central bank is linked with the so-called haircut. We argue that haircuts could be adjusted, taking into account the climate footprint that I mentioned before. So we could have a lower haircut in order to support companies that have a relatively good climate performance, and increase the haircut in order to penalize companies that do not have a good climate performance. We have done some work for the Eurosystem collateral framework, and we find that when we adjust only the haircuts, this weighted average carbon intensity, as we call it, could go down. But when we, on top of it, exclude assets that are considered carbon intensive from the collateral framework, we can have an even larger reduction in the so-called weighted average carbon intensity. People's Bank of China has already green their collateral framework, and actually they have accepted green bonds to be considered as collateral, which is obviously good news. Also, we know that over the last 2 years, governments have issued a lot of green government bonds compared to the rest of the years. So central banks could support even more the issuance of green government bonds. Central banks could include green sovereign bonds in their asset purchases or in the collateral framework with better treatment compared to the other bonds. We also know that development banks, like the European Investment Bank that I mentioned before, issue green bonds. So central banks could not only buy green sovereign bonds, but also green bonds that are issued by development banks as well. So in this way, we can support public spending and lending that is provided to the green economy. I would like also to talk a little bit about the green financing operations. So we know, as I said before, that banks get liquidity from central banks, and in order to do that, they pay an interest. We can adjust this interest rate taking into account climate criteria. So, for example, we can increase the interest rate for banks that have a relatively high proportion of dirty loans in the portfolio in order to penalize them, or we can reduce the interest rate for banks that get liquidity from the central bank and at the same time have a lot of green loans in the portfolio. So in this way, we can induce banks to provide more green loans and less dirty loans. It's quite interesting that a central bank in a developing country, in particular the Bangladesh bank, has already done something like that early on, obviously because they are affected a lot by climate change. So they have green their refinancing operations, and actually they have provided a lower interest rate for banks that are willing to provide loans to support the sustainable investment projects. More recently, the Bank of Japan has offered a zero interest rate for banks that wanted to finance green lending. The last monetary financial policy that I would like to mention is linked with financial regulation. So we can adjust the capital of banks. Generally, we know that banks do not want to hold a lot of capital because it is costly for them. So we can adjust the amount of capital that bank holds in order to promote green lending and reduce dirty lending. So this is what we call the green differentiated capital requirements. Or one of the form of these green differentiated capital requirements is the so-called dirty penalizing factor. So this is when banks should hold more capital when they have provided a lot of dirty loans. So in this way, they might be induced to reduce the dirty lending, and potentially they can increase the loans that they provide to support the green economy. Recently, MNB, the central bank in Hungary, has reduced the capital for banks that provide loans to energy efficient properties. So this is more linked with the so-called green supportive factor and allows banks to have less costs when they provide green loans. So many thanks for your attention. These were some of the green fiscal and monetary policy tools that could be used in order to support the transition to a low carbon economy. Many thanks.
Many thanks to you, Maria. I want to remind people that the Q&A function is open. We invite your questions. I will go through them and pick out some of the best to ask the panelists. And now we're going to turn over to the third panelist, William Oman. And please take it away.
Thanks very much, Peter. It's a great pleasure to be part of this panel. So let me share my slides. Can you see them?
Yes.
Okay, great. So I'd like, first of all, to emphasize that the views I'll express in this presentation are mine and shouldn't be attributed to the IMF, its executive board, or its management. In my presentation, I'll talk about the role that has been proposed for central banks and financial supervisors in addressing climate change. So there are different views on this, and I'll go through the main views that have been proposed. And then I'll take a step back and raise a number of open questions about the role of central banks and financial supervisors in the age of climate change and ecological threats. And in particular, I'll ask whether central banks need a plan B in this age of catastrophes. So let me start with a few slides about the role of central banks and financial supervisors in the age of climate change. So there have been very intense debates on this question in recent years. And so far, two issues in particular have been assessed largely separately from each other. The first is the growing ecological threats to price stability and financial stability. And the second is the ongoing redefinition of the role and actions of central banks, in particular, central bank actions around large asset purchases, liquidity provision, and others. In a recent paper with co-authors from the French Central Bank, Romain Schwarzman and Mathilde Salin, we identify three main normative approaches to the practices of central banks and financial supervisors with regards to ecological issues. And we order these approaches by the rising scale of the response. The first approach is a risk-based approach, where central banks and financial supervisors would address climate change insofar as it poses risks to monetary or financial stability. The second is a proactive approach, where central banks and financial supervisors would proactively address the issue of climate change. And the third is an evolutionary perspective, which emphasizes the context and in which central banks operate, and the fact that the role of central banks and financial supervisors has evolved throughout history and could change in important ways in this new context. And a less common view is that central banks and financial supervisors should refocus on their narrow core mission, in particular, price stability for central banks, because the first best solution to the problem of climate change mitigation is carbon pricing. And I'd like to emphasize that each of these approaches actually rests on very different visions of the world, and in particular, very different presuppositions about money, finance, the role of the state in the economy, and ultimately different theories of value. And these assumptions are, in fact, historically and ideologically situated. So I think there's an important need to denaturalize the state of play and current central bank mandates. And ultimately, this raises the question of the origins of current central bank mandates and the theories, the beliefs, and the doctrines that support these mandates. So let me quickly go through the three main views that we identify in our paper. The first is that central banks and financial supervisors are guardians of financial stability, and it's in that capacity that they need to address climate change. And so for each view, I'll briefly describe the rationale for that view, the main proposals, and the potential limitations of that view. And for the rationale, I'll mention the key assumptions that are made and the key assumptions about the role of money, finance, and the state. So under the first view, the rationale implicitly assumes that money is neutral, that financial markets are efficient, and that the state has a role in fixing markets, correcting market failures. The financial system resilience to climate-related risks falls within central banks' mandates under this view because of climate-related risks to financial system resilience. And in addition, climate change can affect price stability. And so addressing climate change also falls in under central banks' mandate in that regard. Ultimately, the rationale is that central banks and financial supervisors can contribute to the transition by their assessment of physical and transition risks to price and financial stability, and by inducing and requiring financial institutions to carry out this assessment. I'll briefly mention a few proposals. These revolve in particular around the measurement of climate-related financial risks and a potential risk to financial stability and price stability from these climate-related risks. Also, another important proposal that has been already undertaken is to introduce climate stress tests. And finally on monetary policy, there's a proposal to assess the implications of climate change for the design of monetary regimes. In terms of potential limitations, there are a few of them. Under this view, the central bank may indirectly or directly contribute to the buildup of climate-related risks. So this is the notion of double materiality. So the central banks, through its frameworks and operations, could contribute to the very risks that it aims to measure. Secondly, climate risk is extremely hard to measure because of various sources of radical uncertainty. And in addition, good measurement, even if it were possible, of climate risks doesn't naturally lead to good capital allocation. So in terms of mandates, under this view, it's unclear that central banks and financial supervisors would be able to deliver on their price and financial stability mandates, which leads me to the second view, which is the proactive view for the role of central banks and financial supervisors. The rationale here has a very different set of assumptions. It assumes that money is not neutral, it is not a veil, and it has long-term impacts on the real side of the economy, in production in particular. And it assumes that financial markets are not efficient and regularly misallocate capital, and that the state has more than a market fixing role. It has a market creating and market shaping role. Under this rationale, central banks and financial supervisors have considerable power over finance, which in turn has considerable power over the economy. In addition, climate-related uncertainty means that worst case scenarios that are catastrophic for our civilization cannot be excluded, and this justifies a precautionary approach to the role of central banks and financial supervisors. So ultimately, in this view, the rationale is that central banks and financial supervisors, through their powers, can trigger systemic change, and therefore they should play a proactive role in decarbonizing our financial system. The proposals are more ambitious than under the first view. They revolve around requiring regulated financial institutions to submit forward-looking low-carbon transition plans for their businesses, in addition, resorting to things like differentiated interest rates with lower interest rates for low carbon activities, and things like green QE that would exclude high carbon assets from asset purchases by central banks, and also purchases by central banks of low carbon bonds issued by public banks. There are several potential limitations to this view. One is that it could lead central banks to aim to resolve social problems that should ultimately fall on elected governments. The second is that central banks' actions would need to be accompanied by measures in the real economy. So even very proactive central banks would hit a limit in terms of what they're able to achieve, given the structural changes that need to happen in the economy. And third, there could be tensions between existing objectives, such as price stability, and environmental objectives. And here we can think of greenflation, where the transition to a low carbon economy would itself cause considerable inflation in various sectors of the economy. So ultimately, under this view, central banks could deliver, it's unclear that they could deliver on their inflation mandate. And so it's likely that a change in central bank mandates would be needed under this view. And finally, the third view takes a broader perspective, and it emphasizes the evolutionary role of central banks and the state in the economy. The rationale here, again, has a very different set of presuppositions. It assumes that money is a social institution. So it views money fundamentally as a social institution and finance as inherently unstable. And it views the state as critical for coordination throughout the economy. The starting point for the rationale of this view is that central banks may need to work on both of the first two views that I described, but at the same time, they can't substitute for lack of action from other policy institutions like fiscal authorities or industrial policy. And therefore, in addition, central banks and financial supervisors are exposed to green swans, which are risks that that can hardly be predicted ex ante, but that are very likely to materialize and involve irreversible losses and can't be hedged against by individual agents or insured against by individual agents. And these green swans, mitigating these green swans, calls for policy coordination and system change. So the rationale ultimately is that central banks and financial supervisors' role needs to be profoundly transformed, but that transformation has to be part of a broader institutional change. And so this requires an evolutionary perspective. The proposals here are very ambitious, and they imply radical change in our policy frameworks. In this view, central banks and financial supervisors could play a new role within the policy framework. In particular, there would be very close coordination with other policy institutions, but this assumes that fiscal, industrial, and even sufficiency policies that are aimed at moderating consumption to align it with the climate emergency, in particular to reduce energy demand in our societies, all of these would have to be in place. Another proposal is that central banks under this framework would support governments by keeping borrowing costs low and therefore enabling the low carbon transition and the significant public spending on infrastructure and sustainable infrastructure in particular. And in addition, direct monetary financing may be a valid option under this approach. Again, there are several potential limitations to this view. First, it raises the issue of central bank independence as it is currently understood, and the compatibility of the proposals I just described with existing central bank mandates. Secondly, central banks have a limited ability to address other ecological crises, such as biodiversity decline, and they are themselves affected by ecological limits. In particular, there's a growing body of evidence that suggests that some kind of limit to GDP growth, at least in high-income economies, may be needed to remain within planetary boundaries. And this would affect central banks in profound ways. Third, there's a need to consider interactions between the real side of the economy and the monetary and financial side, which may be a shortfall under this view. And ultimately, in terms of mandates, this view may require a democratic debate and a democratic deliberation on the balance between central banks' inflation goal and broader environmental objectives. So let me now briefly go through a few slides on some important open questions that affect these different views on the role of central banks and financial supervisors in the age of climate change. All three of the views I just described may be affected in deep ways by an unacknowledged or under-acknowledged development, which is that we may already be in a situation of ecological emergency. The climate scientist Tim Lenton and his co-authors have proposed this very intuitive equation, which defines a situation of ecological emergency as a product of risk and urgency. And risk in turn is defined as probability multiplied by damage. And urgency is defined as the reaction time to an alert divided by the intervention time left to avoid a bad outcome. And a situation is an emergency if both risk and urgency are high. And they point out that if the reaction time is longer than the intervention time left, we've lost control over the situation. So if we take this notion of ecological emergency seriously, I think it can have major implications for central banking, and in particular for decision under uncertainty, which plays a key role in monetary policy frameworks. And here I'd like to make 3 points. First, climate change poses a big challenge to decision under uncertainty. And here I'm drawing on the work of the Nobel laureate Lars Hansen. He makes 2 important points in particular. First, every model is by nature misspecified, given the complex world we live in. but model misspecification could unravel insights and overturn predictions in quantitatively significant ways. And second, there's a need to, the need to explore model misspecification itself indicates the limitations of our body of knowledge. The second point is related to this first point, and it comes from the economist and philosopher Jean-Pierre Dupuis at Stanford, who notes that with our great power to destabilize the Earth system that has made our civilizations possible, with this great power comes great responsibility, the ethical obligation to know our impacts. But at the same time, this obligation faces profound limits. And he points out two in particular. The first is the objective and structural complexity of ecosystems, which implies that there are unknowable tipping points, which are irreversible and could have catastrophic consequences, but whose specific location and the specific thresholds are inherently unknowable. And secondly, there are unpredictable limits to the degree of to which we can substitute natural inputs with artificial inputs. So there are profound but unknowable limits to the degree to which technological change can address the decline in natural inputs that we are causing through our economic activities. And all of these 2 points, I think, relate to the all-important concept of financial risk. And the concept of financial risk itself could become less relevant because risk compensation and risk insurance can't occur when damages are global. For example, in a global cascade of tipping points. And this leads me to my final slide. I believe all of this implies very important open questions for central banks. And in particular, it raises the question of whether central banks need a plan B. I've listed three main questions in blue. And at the top, I think is an overarching question which captures all of them. In discussions I've had with Bill White, former chief economist of the BIS, he raised the question, are the efforts by central banks to maintain old mandates and old monetary policy frameworks in the face of a truly existential ecological challenge akin to fiddling while Rome burns? And here I'd like to discuss three open questions that I think are particularly important. The first is, what is the right philosophical attitude to decide the role of central banks? In particular, existing monetary policy frameworks assume that we have a stability in the Earth system, which scientific evidence suggests is no longer the case. And this leads to the question of what is the right ethics to decide on the right policy framework for this age of catastrophes. And the economist and philosopher Jean-Pierre Dupuis has suggested that we need a normative assessment which anticipates a retrospective ethical judgment of our present choices. And under this view, so-called no regrets policies would be inadequate because they imply that we shouldn't spend too much in case the worst case scenario doesn't pan out. And this clearly wouldn't be conservative enough. This leads me to my second open question, which is what hierarchy of objectives should guide the choice of policy rules and policy frameworks? In the 1930s, microeconomic goals were subordinated to macroeconomic goals in response to the Great Depression as a direct consequence of the turmoil and the catastrophic impacts of the Great Depression. In the 2020s, in our current era, does macroeconomics itself need to be subordinated to ecology in our current context of climate and ecological crisis? And here I've included a famous quote from the economist Herman Daly, who quipped that the economy is a wholly owned subsidiary of the environment, not the other way around. And this leads me to my final question, which is, what would such an inversion mean for central banks? And in particular, do they need a plan B, which in principle would be closest to the third view I presented, but would go beyond it? And I've listed a number of sub-questions. Would central banks need to revisit their evolutionary role? And would they need to pay more attention to the longer run effects of monetary policy, whereas they currently focus overwhelmingly on the short-term effects of monetary policy? And would they need to pay more attention to their coordination with fiscal authorities and other policy institutions? Secondly, does the situation of planetary emergency justify wartime financing role for central banks? And third, if we use a backward induction approach, would this justify using credit control now? Because we will likely need credit control as a last resort when tipping points appear on the horizon but are no longer avoidable. And finally, would this plan B require giving central banks a new mandate or new institutional configuration? Thank you very much.
Thank you very much, William. And thanks to all three of our panelists for really provocative thoughts. I thought the way the organizers put this together with Yannis and Maria first and then William last made sense, because we got Yannis and Maria kind of doing actual modeling of particular policies. And then we got William kind of stepping back with a 50,000-foot view and trying to help us think through how we would decide, aside from the particular outputs of the models, what's the right thing to do. So overall, a great bunch of panels and presentations, and we have some good questions coming in, which I will sift through. I'm not going to be able to ask all of them. I want to start out by asking Maria just a question. In the model that you used to generate your outputs, what was the equation about, what were the assumptions about the amount of slack in the economy? For example, there are people who would say, well, if you're up against supply side constraints, then maybe some of the green subsidies and public investment would be more inflationary and would not have the positive impact on the economy that you envision. Talk about that a little bit.
Yes, thanks, Peter, for this. So obviously, when we talk about the modeling, we make a lot of assumptions and we clarify these assumptions. And based on these assumptions, we get specific results. In the model that we have co-developed, we have assumed that the output is demand determined. So as a result of this, an increase in green public investment has positive effects on the economy. If we had a supply determined output, probably we could have a kind of a crowding out, and as a result, we wouldn't have these positive effects on economic activity, reduction in unemployment rate that we would expect. Also, the financial system plays a key role in our model, and as a result, when firms take out loans, they might end up being more financially fragile. So this is another key issue that leads some of the results that we have. So we take into account that firms might, let's say, increase their loans in order to invest more in green, to have more green capital. As a result of this, and they might end up more financially fragile, and this will have feedback effects on the banking sector, and we might end up with insolvent banks. So in this case, expansionary policies like green subsidies and green public investment could avoid the defaults, but carbon taxes would have negative effects. So it would increase even more the inability of the companies to pay. So these are some of the key assumptions that we have made in the model, which is more in line with the so-called heterodox approach and the post-Keynesian approach on stock flow consistent models. And also we take into account ecological limits that are importantly model and the feedback effects that this might have on the environment. So, but in any case, these are some of the assumptions of the model, but happy to discuss a bit more later if.
Thank you. Yannis, a question for you in your presentation where you talked about how monetary policy is harder to conduct in a world of climate change. And you mentioned climate, fossil, and greenflation. What about them qualitatively makes them harder to address than other sorts of problems that central banks have faced over the decades?
Yes, I mean, of course, one key issue for central banks is that they cannot easily control the source of inflation, but I also highlighted that from a qualitative perspective, several channels through which the monetary policy authorities try to affect inflation also change completely. So there is this assumption that central banks can basically change the credit that is provided to the economy through interest rates. They can change asset prices through the interest rates. But once we have that there are this so-called transition risk of climate change with a completely new structure in the economy, with carbon-intensive companies going down and other sectors becoming more important, we have that it's not easy for central banks to control inflation using these channels. So for example, we have asset price decline because there's a transition to a low carbon economy and the stock prices of carbon intensive companies go down. Central banks cannot easily deal with that by just using the interest rate. So from a more qualitative perspective, the overall inflation targeting framework is going to change because of the realities of the climate crisis. And many central banks have focused quite a lot on the transition risks, but in my view, they underestimate the implications of the physical risks, which can be much more substantial and much more permanent, and we can have a very different economic system because of the climate shocks. I think this is something that requires more attention.
Thank you. And William, one thing I really liked about your paper, you work for the IMF, you have to be careful, even though you express that this is not the official view of the organization, even so, you don't want to inject too much personal opinion in there. I thought you did a very good job of portraying each of the views quite fairly. And but I have to say, this is always a problem in economics, that economists kind of can talk past each other because their worldviews are so different. So I have sort of a meta question for you. If you have people who have these three quite different views, they have to somehow arrive at a solution. How do you even get that conversation going?
That's a great question. Thanks, Peter. I think what we're trying to do in our paper is kind of take a step back. As you said, it's a very sort of meta approach, and show that there's a sense when you follow the policy discussions that things have always been thus, and to kind of show that we need to denaturalize these mandates, that central banks are institutions that didn't come out of nowhere. They appeared in a very specific historical context, and their mandates by the same token emerged for a very specific set of reasons. And that we face our societies today face entirely new challenges that are totally unprecedented in their scale and potential implications, which are truly existential. And so I think the bottom line is that there's a need for deliberation among economists and more broadly to lay out different options and what they imply about how the world works, and have an open deliberation. And I think this is fundamental to arrive at sort of robust institutional coordination to achieve the best outcomes.
Yeah. Again, I'm not going to be able to go through all the questions. There was one I particularly liked from Susan Borden, and she asked, might anybody have a comment on the possible usefulness of the sort of bond Uruguay issued in 2022, a $1.5 billion USD denominated sustainability-linked bond maturing in 2034 with a step-up coupon if it fails to meet its targets for both a reduction in greenhouse gas emissions and the conservation of native forests, and a step down if it exceeds its targets. Any thoughts on that from anyone of the three of you?
I can go first, probably. I think the idea of the sustainability-linked bonds is a good idea, because it means that generally corporations, governments could issue this type of bonds in order to fund specific activities that they have identified. So in this way, we might be able to avoid the types of issues of greenwashing. Of course, at the same time, we don't expect that we can use only sustainability-linked bonds. There might not be enough, irrespective of the magnitude of their specific one, which is quite high. But in any case, we need to think that there might be a possibility for corporation governments not be able to pay this sustainability-linked bond, and they might not be able in some cases to reach their targets. If this is the case, the interest rate will increase even more, so they will will have a higher cost to pay. So this might affect their financial fragility and their ability to pay. So I would say that with, in any case, with any type of policies or tools that could be introduced, we might have some beneficial effects, but also some detrimental effects that we need to take into account. Thank you.
Sure, sure. There's a great question here from Lana Larga. I don't know how to pronounce the last name. As we hopefully transition to green energy, can we include a job guarantee as proposed by Dr. Cherneva to avoid a steep reduction in income for fossil fuel workers? Anybody's thoughts on that?
I can take this one. I think it's a great idea. I mean, we need to find ways to support workers. And I mean, having a jobs guarantee program, of course, makes a lot of sense because it means that those who are going to perhaps lose their job, they will have the opportunity to find a job in the public sector. Of course, this needs to be accompanied by training programs because people have different skills when they work in the fossil fuel sector, and they might need to have very different skills if they need to work in another sector. But I think at the same time, it's also important to think how we can support this transition also in countries in the global south, where it might be a bit more challenging to implement these programs. And in that case, I think would be very crucial to make sure, as I highlight in my presentation, that there's sufficient financing that is provided by countries in the global north to the global south in order to allow them to do something similar. Because we cannot just focus on the transition in the global north. But I think in general, it could be part of a broader climate fiscal policy mix.
Also, can I just ask the two of you, Yannis and Maria, what you thought of William's presentation?
We can start a very big discussion about that. Maybe I can a couple of comments. I think the second view that William presented, I wouldn't say that this, in my view, inconsistent with the third view, because at the end of the day, having a more proactive role for central banks overall is in line with the idea that central banks need to participate in the climate transition. And of course, central banks cannot deal with everything, but I agree with William that they have a role to play. And I agree that we need to have a more proactive role for central banks when it comes to financing government spending. I think what is perhaps is very important is again to consider that we need a system-based approach to the problem. I very much agree with William on that, which means that we need to have this coordination. And I would like to add two things. One is that I don't agree with the idea that the first view is about financial stability. In my view, financial stability is part of a system-wide interaction. So I would say that financial stability from a macro level can be ensured more easily with the second and the third view compared to the first view. And I think it would also be great for the second and the third view to work more on how we deal with climate adaptation and loss and damages, because I think William primarily focused on mitigation. I think it would be great to also think how we can use innovative tools in order to deal with adaptation and loss and damages. But I mean, I very much agree with the systems-based perspective and the fact that we have to find new ways to deal with ecological crisis.
Any thoughts, Maria?
Yes, I think I would agree with almost everything that Yannis said, but I would like to talk a little bit more about this coordination problem that William mentioned towards the end of his presentation. It was with a kind of a question why it makes sense to have a kind of coordination between monetary, let's say, policies and fiscal policies, because in any case, if the government does some action in order to support a green transition, we don't want central banks to take actions that actually are going to increase, let's say, emissions and go against the fiscal policies. Yeah, that's it. Thank you.
Okay. I'm going to read one more question from Alistair Leaf. It's been said of integrated assessment models that the only thing they tell us are the assumptions of the modeler. Financial models of the Fed couldn't see the 2008 global financial crisis. How cautious should we be with regard to modeling around climate change when the risks are existential? I'm not reading every word here. And the uncertainties and non-linear behaviors continue to elude us. Any thoughts from anybody on that?
Maybe I can take this one. So this actually is very closely related to something I mentioned in one of my slides about, I think it was my last slide about this proposal that we need a normative assessment of what we're doing that anticipates a retrospective ethical judgment of present choices. So given all the knowledge that we have and how catastrophic the consequences of a bad scenario would be, this implies, according to some, that we need to go beyond the sort of conventional wisdom of things like no regrets policies, cost benefit analysis that assume that we know the distribution of the distribution of probabilities, that we have a certain handle on things. If we're talking about truly existential risks, that the sort of consequentialist approach where you can weigh different outcomes against each other doesn't really hold water. And so this proposal is that we need to act in a way where the future generations won't be able to judge our actions as insufficient. So it goes beyond the sort of the precautionary principle, and it has potentially profound implications. And the idea is to kind of assume the worst is going to happen almost for certain in order to forestall it. So it's kind of paradoxical, but there's a whole kind of tradition around these approaches that is, I think, quite powerful and part of what we need to do.
Okay, I have one more question. This might end up being the last one. We'll have to see, because we're going to wrap up in about 4 minutes. But this comes from an anonymous attendee, and it's about the Bridgetown initiative, which came out of the Barbados last year, and I didn't know much about it, but anybody have any thoughts about that concept?
I perhaps can take this one. My view is that this is, of course, an initiative that is necessary. I mean, it's very clear that now countries in the global south cannot deal with all the spending that they need to make in order to address climate adaptation and loss of damages. My view is, however, that this does not necessarily go far enough, because in my view, the starting point of these initiatives should be climate justice. And climate justice means that the problem has been created primarily by countries in the global north, and now countries in the global south that have very low responsibility have to deal with that. So of course, it's great to use SDR, special drawing rights, to support spending in the global south. Of course, it's great to have some reduction in debt and to have some debt relief programs. It's great to have the bonds that were mentioned before and so on. But I think we need a much more radical approach whereby countries in the global north take responsibility for the problem and provide much more financing in the form of grants in the global south based on the fact that we have an injustice issue. And I think it's great that we are having this initiative, but in my view, this has to go even further and try to incorporate explicitly climate justice. It's not politically easy, of course, to do that, but I think we need to think more in this direction.
Great, great. Anybody else want to add to that?
Maybe very quickly, again, this is my personal opinion on this, but I very much agree with what Yannis said. And I think the problems are truly systemic, and so we need systemic solutions. And this includes a new institutional architecture for debt distress in the global south, and also looking at the rules of the international game more broadly. Are countries allowed to pursue their domestic development paths, and what is the role of international bilateral trade agreements and so on, and how constrained are countries in the global south, and do they have the means to achieve low carbon resilient development or not? And if it's not the case, we're basically creating a double bind for these countries, which we should absolutely avoid.
Right. All right, well, I think I'm going to wrap it there. We're just about out of time, and I love finishing on time. Thank you very much to Yannis Dafermos, Maria Nikolaidi, and William Oman for a great presentation on climate change and monetary and fiscal policy. And now back to our host. Is that Dimitri coming on, or who's coming on next?
We'll take a quick break.
Okay. Hi, Dimitri. Well, bye, everybody. Thank you again.
Thank you so much.
Thank you very much.